Welcome to Lesson 2 of Module 5. Today, we will explore a fundamental topic for any cryptocurrency investor: cognitive biases. These biases are basically shortcuts that our mind uses to make decisions faster. However, in many cases, these shortcuts end up leading us to mistakes, especially when it comes to financial decisions. Understanding how these biases work is essential for anyone who wants to invest with more confidence and avoid common mistakes. So, let's start with the basics. What are cognitive biases? Simply put, they are mental tendencies that help simplify the decision-making process. This seems great at first glance, but in the financial context, it can be a serious problem. Why? Because these shortcuts can lead us to make impulsive, poorly informed, and often quite risky choices. And in the cryptocurrency market, which is highly volatile and dynamic, this can be especially dangerous. Now, I want you to pay attention to the main biases that affect investors in the crypto market. The first is the anchoring bias. This bias occurs when we fixate on an initial value, such as the purchase price of a cryptocurrency. This initial price starts to influence all our future decisions, even if it no longer reflects the reality of the market. In the cryptocurrency market, where prices change quickly, this can be quite disruptive. Another very common bias is confirmation bias. Here, what happens is that we seek information that confirms what we already believe, while ignoring any data that may contradict our beliefs. For example, if you believe that a certain currency will be successful, it is very easy to ignore warning signs or negative news about it. And what about the herd effect? This is the famous behavior of following what everyone else is doing. If everyone is buying, we feel the need to buy too. The problem is that by following the crowd without analyzing the situation, you can end up entering a bubble or making very risky decisions. We also have loss aversion. This is the fear of losing money that makes us make overly conservative decisions or even sell assets at the first sign of a decline. This is especially problematic in the cryptocurrency market, which is notoriously volatile. Dips are often short-lived, and selling out of fear can miss out on opportunities for recovery. Another bias worth noting is the illusion of control. This bias makes us believe we have more control over the market than we actually do. This leads to an overestimation of our abilities and can lead us to take unnecessary risks. What about availability bias? This bias makes us give more weight to information that is fresh in our minds. For example, a recent news story about a coin can influence our decision, even if older or more relevant data points in another direction. Another interesting example is the representation bias. It makes us judge the likelihood of an event based on stereotypes. In the crypto market, this can translate into believing that a coin that seems similar to another successful one will also do well, which is not always true. In addition, we have the status quo bias, which makes us prefer to hold on to what we already have, avoiding changes in our portfolio. This can result in holding on to investments that are no longer advantageous. And, of course, we cannot forget about excessive optimism or pessimism. Both lead us to distort the chances of success or failure of an investment, either by taking unnecessary risks or by being too conservative. Last but not least, we have the self-confidence bias. This is the tendency to overestimate our skills and knowledge. This can cause us to make decisions without the necessary analysis, relying only on our own judgment. So, how can we mitigate the impact of these biases? First, we need to know ourselves. Recognizing our own biases is the first step. Education is another key point. When we understand how these biases work, we can act more consciously. In addition, it is important to seek information from different sources, question our beliefs before making any decision, and follow a well-defined investment plan. Discipline is essential here. Another strategy is to diversify the portfolio. This reduces the impact of biases such as anchoring or overconfidence in a single asset. Finally, sharing experiences with other investors and seeking professional advice can bring more objectivity to our decisions. So, to conclude, I want you to take this with you. Cognitive biases are natural, they are part of who we are, but in the cryptocurrency market, they can be especially dangerous. The secret is to recognize them, understand them, and act strategically to avoid their negative impacts. If you want to learn how to navigate this market more safely, Take advantage and sign up for our complete course, Practical Guide to Investing in Cryptocurrencies, from zero to confidence in the digital market for free. If you like this content, leave a like and subscribe to the channel for more classes like this one. The link to the course is in the description. See you in the next class.